Well, U.S. stocks have kicked off the new month in negative territory, and the major averages moved even lower following the release of two manufacturing production data points. The S&P 500's Global Purchasing Managers Index remained in contraction in August, and the ISM's PMI reading came in lower than expected. So, of course, welcome to all of our viewers this morning. To all of our viewers from the U.S., Korea, and around the world, welcome to Global Money Talk by SamPro TV, live from the floor of the New York Stock Exchange. I'm your host, Remy Blair, and you are watching the inaugural broadcast of Global Money Talk. We're very excited to bring you the very first show this morning as we kick off our daily show. And we will begin the hour with our market briefing for live coverage of the U.S. markets. We will then bring you market insights for an in-depth conversation with market experts. Today for the Market Insight, we have Tai Wong, an independent proprietary trader, for an expert discussion on gold. So make sure to stay on for the entirety of the show. But first, for the market briefing, let's welcome J.D. Durkin, CBS contributor and host at Public.com. J.D., good morning and welcome on to the show.
Well, we say good, really, it's a great morning. This is awesome. What an exciting day to be here for the inaugural launch of the broadcast, and no one better I'd rather sit here with than you, Remy. Good to have you.
Yeah, absolutely, J.D. So here we are. We're back from the holiday weekend. We are seeing markets in the red. So what do you make of what we're seeing in the equity averages today?
We can't forget this is historically the weakest performing month for equities as well as bonds, and that goes back well more than the last 10 years or so. Even though that we are coming into the month of September here on a 4-month win streak for the S&P 500, we are seeing a lot of pullback, a lot of profit taken on the table today, and that's true for the S&P 500, currently down about 1.4%. The tech-heavy NASDAQ, which of course trades at the market site here in New York City up in Times Square, down more than 2% to start the month of September on the shortened trading week rather. The Dow is down over 1% as well, and then you and I were talking, Remy, about the small caps and the Russell really taking the brunt of this selling today, down more than 2%. So really fascinating look, I think, to break down the sectors and get a sense on what is moving in positive direction. There aren't a lot of them. Healthcare up fractionally, consumer staples up fractionally at this hour. Similar story for utilities and real estate, some of those sectors that tend to lag behind the broader market. In positive territory barely, but for the most part, we're in kind of bearish territory, at least for right now.
And JD, you brought up an important point, because if we look back at the month of August, we saw a volatile start, especially on August 5th. But we have to keep in mind that the major stock averages ended with gains. And here we are, you mentioned the September effect, and we did get the release of some manufacturing production figures. And once we got the release of those figures, we saw the markets go even lower. But of course, this week, it's all about the labor market. So what do you expect to see as we head into this week? Lots of data points.
We got a lot of data points for sure. We got those manufacturing numbers, maybe a bit disappointing to the downside because we saw that acceleration of selling in futures contracts before the market actually opened. We've got ADP payroll figures out Thursday, but really the big one Friday morning, Bureau of Labor Statistics, really giving us that top line figure. But we also had a bit of dose of reality as it pertains to the job market, Remy, just a few weeks ago. We can't forget, we get these numbers, and they're really just kind of an initial estimate, right? Because then we kind of later tend to get downward revisions, which we just learned recently. It was about 800,000 fewer jobs across the U.S. economy over a 12-month period than we had previously believed. So I even say for Friday morning's number, even if it's a positive number, take it with a grain of salt. There may be revisions down the line here, but this certainly sets the stage to your point. We thought August was volatile. We saw the VIX spike during that August 5th sell-off, and then at one point we had the S&P 500 was down over 7% for the month of August, certainly finishing through in a very strong way, crossing the finish line there late in the month. But we know historically September and October are very choppy, so I know more than a few investors, history does not repeat necessarily, but we like to take our cues from what happens in previous cycles. It's a lighter volume month of the year, so we could be in for a choppy few weeks, but we do have the Fed meeting after the jobs report as well.
And here in the U.S., we had the Labor Day holiday weekend, and because of that, some of the economic data releases are coming out on days that they traditionally are not released. But you mentioned VIX, and earlier in the month of August, we saw that VIX spike above 60, something that we haven't seen since the beginning of the pandemic. And here we are today, the VIX is at 18, so that gives you an indication of where volatility is right now. And I'm also glad you brought up those BLS PLS figures because that was a staggering figure, but of course that could be revised as we head into next year as well. So I do want to take a look at what's happening across the markets. You covered the major equity averages. We mentioned what's happening in terms of volatility, and we talked about economic data that you're paying attention to this week. So tell us a little bit about what you're watching when it comes to fixed income as well as currencies today.
Yeah, of course. I mean, we're following overall the U.S. rates. What was fascinating to me between the 2- and 10-year yield spreads that we had on Thursday. Thursday, the big storyline. Wednesday, Thursday of last week, we were also closely focused, and understandably so, on NVIDIA earnings. Yep. But we actually had this, really interesting movement between the 2- and the 10-year yield. The 10-year was 2 basis points below the 2-year, so we started to have this inversion nearly back to normal. Really important on the bond side of things, but I would argue kind of got lost in the shuffles. We were all focused so heavily on earnings out of NVIDIA. I think this is part where the traders are pricing in those interest rate cuts for September, so we'll continue to follow the kind of 2- and 10-year yield movements very closely in the relationship between the two. The dollar index was trading at about 101. It's well off of its highs that we saw trading earlier in the year in April and June when we saw that figure north of about 106. And for the oil, I think for the oil market specifically, for the most part, has been okay. Obviously, we have geopolitical concerns. We have political disputes in countries like Libya that is going to impact I think some of the output for some of those countries, but for the most part, I would argue, kind of stable overall in the global market. Of course, here at home, we follow WTI, that's the domestic benchmark, and then we follow Brent crude for the global benchmark on that commodity as well. So despite a lot of concern out there, for the most part, as of late, it seems like we've had a nice degree of stability. I know everyone wishes gas prices were as cheap as they were 4 or 5 years ago. We're quite a bit off of those levels, but for the most part, we've seen a nice stability.
And speaking of oil prices this morning, as you mentioned, WTI, that is lower by 4%. Brent crude futures are also weaker and in the red as well. And while we're taking a look at the commodity prices, we are seeing the major stock averages weaker in today's session. Right now, we'll do a quick check. The Dow Jones Industrial Average is down by over 400 points, while the S&P 500 is down 1%. And the NASDAQ Composite Index is lower by 2% as well. But you mentioned NVIDIA, and that was such a key focus last week, and sky-high expectations were prominent last week. So one thing that I do want to mention to our viewers who are watching from around the world is that here in New York there was talks of NVIDIA watch parties. Did you attend one, JD?
I did not, but I kind of had FOMO that I missed them because I saw them on social media afterwards, and I said I would love to be at a bar with other like-minded financial nerds like we are watching these numbers, but no, I was at home with the dog, watched them as they came across the wire. And it was a fascinating story, right? Because it was a beat.
JD.
It was a beat on top and bottom, just maybe not as strong a beat as we've been used to for a company that's more than 6% of the entire S&P 500. And we always watch those customers of NVIDIA, which are Microsoft, which are Meta, which are Amazon, a few others. At what point do they increasingly build their own AI capabilities, and in doing so move away from their reliance on NVIDIA? It doesn't seem like they're there quite yet, but that's a potential headwind for a stock that has arguably been the most important name in the S&P 500 over the last 18 months or so. So it was a fascinating, closely watched earnings report last week.
Yeah, well, JD, you weren't alone when it came to FOMO, because I was hearing about these watch parties for NVIDIA, and I was thinking, wow, what a difference that a year makes, because NVIDIA watch parties weren't happening last year. And if you look at some of the stories out there, you saw that all the screens in bars had NVIDIA earnings, the conference call airing in the background. And usually when you go to a sports bar, you expect to hear what's going on in terms of the game. But as you mentioned, sky-high expectations. That's why we saw shares decline after they reported results and even after the open, once the stock market opened in trading.
Yeah, listen, I mean, we all go to the bar to watch sports games. We go to watch the U.S. Open. Now we can go to watch our favorite earnings reports. Maybe next quarter. We'll have to find somewhere down here
maybe then we can do some live coverage. And now that we've taken a look at the markets, let's move on to some top news stories that people here in the United States are focusing on this morning. So can you share some of the headlines with us, JD?
Yeah, well, we are 60 days and change away from a huge U.S. presidential election, I'm sure you've heard. And so really, I think the first story here at home I'm following are these dueling messages of economic populism from both campaigns. Of course, we're talking about Donald Trump on the one hand and Vice President Kamala Harris. The Harris campaign, as well as with President Biden, holding a major Labor Day event yesterday, really trying to, I think, further secure union support that has been foundational to Joe Biden's, not just presidency, but I would argue his entire political campaign back to when he was elected to the Senate at only 29 years old, looking to kind of continue that momentum now for his heir apparent, Vice President Kamala Harris, alongside Minnesota Governor Tim Walz. And I think looking for those dueling messages on everything from the extension of the Trump tax cuts to what it means for infrastructure spending and how the two campaigns kind of position themselves. One of the big stories here at home, and a big news line specifically for the world of steel that came out of that event in Pennsylvania yesterday. Pennsylvania, arguably the most important state for both campaigns. 19 electoral votes up for grabs. A lot of prognosticators think whoever wins the Commonwealth of Pennsylvania probably wins the overall election. Harris yesterday saying U.S. steel should stay American-owned. Of course, we had this nearly $15 billion deal announcement that said, there would be a proposed takeover of U.S. steel by Nippon Steel in Japan, something both President Biden and Vice President Kamala Harris yesterday said. And I should say, to the roaring support of the crowd there in Pennsylvania, that should stay U.S. owned. We are seeing a lot of downward action on that stock today. We've been tracking it. U.S. steel shares down more than 3% so far to kick off the month of September. We'll closely watch it, I think, over the next few weeks. It's going to be a long, drawn-out story, but it is worth noting what the Harris campaign says, and I'll be closely following for the days ahead for how former President Trump responds as well.
And JD, you have experience covering politics. I'm sure that you're keeping an eye on what unfolds on a day-to-day basis, but as you mentioned, we are seeing shares of U.S. steel down by about 3.5% in New York morning trade. So what else are you focused on, JD, this morning?
Another issue, and I think this kind of gets into politics here at home, but also items around the world, is the real proliferation of artificial intelligence images, specifically on social media. Remy, I know you and I both spend a lot of time on platforms like Instagram, platforms like X. I have been stunned because I was a politics reporter for years, but we're really seeing AI-generated images and videos sort of go after and in many cases intentionally impersonate some of our world's most influential figures, and that includes Trump, Harris, Biden, Obama, Elon Musk himself. And I think while it's still being done very much in a kind of joking type of way, I think this does open up the door to the threat of what AI-generated misinformation means, not just for the election here at home, elections that are happening in democracies all around the world. And then what does this mean for markets? What happens if and when, God forbid, we get to an era where AI is being used to, coincide with earnings reports? Like we said, what if everyone's at the bar for NVIDIA earnings, but it's an AI-generated info that starts to move the market one way or another? So it's a danger I've noticed really in the last few weeks that's definitely worth keeping an eye on as we move forward. That's another big story for sure.
And JD, you bring up an important point because it's been a big year for global elections. Over 50 nations holding elections this year. And it was really interesting you bring up AI. So in India, the government actually experimented with AI and even had AI news anchors. So if you think about what that means, right, for us, for people who are on air and experimenting with on-air journalists, what do you think of that?
Well, first of all, to clarify, Remy and I are actual human beings. We are sitting here. Our producers are all real. This is not an AI-generated show. I understand it. I think it is the most exciting technology to come around. I think from time to time we have these shiny things in the markets, right? It's this thing or it's that thing, but this really seems like this has the staying power, promises to transform entire industries, but there is a bit of a double-edged sword. I think it's kind of contingent on all of us as news consumers, as smart investors, to do our due diligence, try and best separate what is actual and what is simply being generated by artificial intelligence, and making sure those lines aren't blurred wherever possible is really important.
Absolutely.
Yeah.
And in this election year, we'll have to keep an eye on those deep fakes, as you mentioned, JD.
Yeah.
So as we move on, what else are you watching today?
Yeah, a really interesting story. You know, if we think back to that August 5th sell-off, had to deal with the Japanese yen, the carry trade. The head of fixed income at T. Rowe Price is now looking at the fact that the Bank of Japan is in a fundamentally different situation than our central bank is here at home. So the BOJ, of course, is one of those rare central banks that's still in a interest rate increase cycle. Calling it the head of T. Rowe Price there, it's the San Andreas fault of finance, now warning as recently as this morning that he's just seen the first shift in that fault and that there is more in terms of expected market volatility. We are seeing the yen rise this morning in relation to the US dollar by more than 1%. So for all of these concerns that we had talked about a month ago, when we saw the VIX spike, when we saw this, this massive one-day selling in U.S. equities, any of those underlying concerns with regards to the Bank of Japan may not be entirely off the table. A really important story, I think, to keep in mind this morning and as we move forward in the month of September as well.
And you brought up a very important point there, because when the sell-off was happening on August 5th, it was the unwinding of those key trades, and we're keeping an eye on comments coming out from the Bank of Japan. But for the time being, it does look like the Bank of Japan will not be moving anytime soon. We'll see how that affects the yen currency, and of course, whether this carry trade will continue. But what else are you watching, JD?
Yeah, and another big one in terms of global politics. Of course, hundreds of thousands of Israeli citizens taking to the street to protest the government of Benjamin Netanyahu. This was tragically after 6 hostages were found dead in Gaza. Even President Biden, a bit of a rare rebuke against the Israeli leader, kind of indicating that Netanyahu is not doing enough to reach a ceasefire deal, and a very rare apology from Netanyahu, apologizing to those families as well. Those were really stirring images the last 48 hours. Really an important story in terms of geopolitics to keep an eye on, and something that will probably be talked about a lot more in our U.S. election from now to November as well.
Yeah, and I'm sure we're going to be hearing from both candidates when it comes to geopolitics. So you and I, we spend a lot of time here on Wall Street, and of course we pay attention to what happens in terms of economic data, but in terms of how geopolitics affects the markets, it really depends, doesn't it? So based on your experience, how do you pay attention to what's happening in geopolitics and really discern what affects the markets?
I think oil markets tend to be where I focus, because we have these clear benchmarks, and lucky for us as reporters on the floor of the New York Stock Exchange in real time, Remy and I can look up at the big board, see where WTI is trading, see where Brent crude is trading, and then I also, because I covered politics, I look at the output from the OPEC plus countries, and then what are the efforts from other non-OPEC countries to try and rival those output challenges in order to kind of suppress the costs of fuel, right? I mean, arguably, I think we saw the Biden presidency forced to do things in terms of oil and global commodities they probably wouldn't have wanted to do otherwise, but when faced with those inflationary pressures, say, hey, we can, on the one hand, try and pass pro-climate legislation, but on the other hand, we can continue to drill if there is a drill baby drill president. Ironically, it probably is Joe Biden, because we are looking at record high outputs. So I think in terms of geopolitics, we do have those at-home measures, and I think really oil is arguably the most important one to look at in terms of our impact, because we're all using fuel every day. We're all impacted.
Indeed. I do want to take a quick look at the markets right now, and we are seeing the major equity averages still in negative territory. The Dow Jones Industrial Average and S&P 500 are off by over 1%, and the Nasdaq Composite Index is down by 2%. And of course, when it comes to crude oil futures, we are seeing weakness continue, with the front month contract for WTI off by a little under 4% on the session.
Can I hit on just a couple of the stocks that I think are noteworthy? Obviously, when we talk about the Dow, as we certainly know, is 30 components. The vast majority of Dow companies are starting September down into the red. The most weighted name in the Dow, the most important name, ironically, is UNH. That's United Healthcare. It's actually having a very strong day, up 1.3%. But Goldman Sachs, very heavily weighted name in the Dow, is getting hammered, down more than 4%. Comparable story for Caterpillar, the 5th most weighted name in the Dow. If you look at these tech consolidated names that tend to drive the NASDAQ or the S&P 500, Apple's down more than 2%, Microsoft down 0.8, NVIDIA down more than 7%, obviously a very choppy, volatile stock. So a lot of those big tech names, if they're going to be in the red, pretty safe assumption the broader market will be in the red as well.
Well, I think it's always healthy to take a look at the breakdown when it comes to the names that are in the Dow Industrials. And I'm glad that you brought up NVIDIA because it just shows how much we are down right now in today's trading session. So as we head into the rest of this holiday shortened week, JD, of course we're paying attention to economic data releases and of course what the implications are for that key Fed Reserve meeting in mid-September. So we heard from Jay Powell out in Jackson Hole, Wyoming. It must have been very nice that time of year, right?
It looks so nice out there.
Yeah, indeed. Hopefully one day we'll be able to attend one of those Jackson Hole symposiums where Jay Powell speaks. But in terms of what you're paying attention to, not just today, but as we head into this month, what are those key data points as well as events that you're watching, JD?
Well, obviously, I think, payrolls we talked about this week is going to be crucial. We'll get the Fed Beige Book information later on this week. Durable goods for the month of July actually comes out later on this week as well. So some of those data points where we could watch specific secular sectors more closely than others will be really important. But then I think in terms of September, we watch overall for volume. We'd want to get a sense, are we still kind of at the very end of these dog days of summers where volume tends to be pretty low? People are trying to stretch that, kind of last few days of summer vacation. But now as it's back to school, now as more families are back to their rhythms, I'll be looking for that uptick in volume. Try and get a sense on what is the market reaction? We're all sitting here basically assuming that September 18th will bring that first big rate cut here in the United States. I think popular thinking has been that might be a bit of rocket fuel on U.S. equities, but if there are kind of other presumed fissures, we may not really have that reaction the 18th, 19th, 20th that we're really expecting here. And then, of course, that's the last Fed meeting until the election. So we're kind of on this collision course of all these different stories in monetary policy and fiscal policy, electoral politics, geopolitics, all colliding at once. So these are the sorts of months where people like Remy and I are very thankful for coffee and lots of caffeine because we probably won't be sleeping a whole lot in the next few weeks, trying to do our best to keep our finger on the pulse of all these stories.
Yeah, and JD, if you think back to this summer, right, from politics, geopolitics to market volatility, we got all of those things, and traditionally August tends to be a pretty quiet month in terms of volume and event risk, but we had so many things happen in terms of politics and, of course, market volatility. What did you make of some of the political events that really moved the markets this summer?
I think in terms of, it's tough to even remember but I think July 21st was the day that President Biden said he would not run, and so basically we've been in this 40-day shortened sprint of an election. Usually presidential cycles go on for more than a year. Unfortunately, here in the U.S., we're really dealing with what's basically a U.S. snap 100-day election for the first time, and I think everyone's just trying to figure out exactly what that means. I would like to hear more from both campaigns about sound economic policy. We always say you campaign in poetry, you govern in prose. Part of the challenge for both Donald Trump and Kamala Harris is that if you become president, a lot of the big things you want to get done, you need 60 votes in the U.S. Senate. Neither of these candidates, spoiler alert, is probably going to have 60 votes. So you have to really compromise. You're going to have to try and sell a degree of economic packages to your voters that might not actually be realistic if you've got a razor-thin margin. You got to start to compromise, get some of what you want done on the economy, and also kind of give some points to the other side if you're actually going to get these bills onto the president's desk, whoever that president is. Just important to notice as you hear the campaign, you hear a lot of big promises, but when it comes time to governing, the challenges are a lot more difficult.
And as we head closer to that November date, the U.S. presidential election, I'm sure both of us will keep our eyes and ears open for more clarity when it comes to economic policy. But I do want to ask you, when it comes to presidential election year, what do you typically see when it comes to U.S. stock market reactions?
Yeah, markets actually tend to do pretty well during presidential election years, even if it's a big wait and see. I mean, in my estimation, I think investors have really short memories. They are really good at finding the silver lining. My take throughout this year has been no matter who wins, pending some unforeseen economic calamity we're not thinking of just yet, the market will probably find a way to be resilient and go up anyway. And I argue that because if Vice President Harris and the Democrats have a clean sweep, investors will think, great, that's more on manufacturing spend, that's more infrastructure spending, and we love that. If Donald Trump and the Republicans win, that could mean more tax cuts to the forefront, which investors really like. And then, of course, if there's kind of a split result, one party controls this, the other party controls that, that means less of a path forward on regulation against some of these big tech companies that have driven the market to new highs. So that's the long way of saying no matter what happens, I think investors will find that silver lining, and ultimately these are financial instruments that are designed to go up. Maybe not in the short term, but I expect some market optimism regardless of what happens in November.
Well, we'll keep an eye on what happens here on Wall Street, and we'll do a quick market check as we quickly approach the 11:30 hour. So right now we are seeing the Dow Jones Industrial Average lower by over 1% or 460 points. The S&P 500 is extending losses as well, down by 1.4%, and the NASDAQ is also down right now by over 2.2% or nearly 400 points. Very quickly, taking a look at crude oil prices, they are down about 3.5%, and then gold futures are nearly flat on the session as well. So JD, we are seeing red across the board as we kick off a new trading week as well as new trading month, and we'll continue to keep an eye on what happens. But as we head into the rest of this week, what are some key things that you'll be paying attention to in addition to all the economic data?
Well, I'll start with the anomaly in the sectors of the S&P 500 today, because Remy, as you know, it's not often where we say, wow, technology stocks are getting absolutely hammered, but real estate and utilities are doing pretty well. But that's the kind of upside down world the market brings you sometimes. Today, technology is the biggest laggard in the S&P 500, down more than 3%. Energy stocks also getting hit really hard. So I'll look to see if that continues in as this first trading week of September moves forward. And then, of course, it's all about that jobs data. What do we learn Thursday through ADP, Friday from the Bureau of Labor Statistics to reinforce the soft landing narrative? It's all about a narrative. It's a sentiment. It's a vibe as we get closer to the central bank. I'm so excited that they're actually going to cut interest rates. We've been talking about this for years.
My gosh, I know, right?
Finally, this might actually happen here. And so what do we get Friday? I don't think one way or another it'll kind of influence the Fed too far away from what they already think they're going to be doing, but we want to have that soft landing narrative reinforced a bit more to say, was the Fed actually successful at bringing down inflation, cooling those inflationary pressures without driving the United States into a recession? That's the sweet spot. Much easier said than done. Friday morning is, I think, the most important piece of information we'll get for the next few days towards that end.
Yeah, and as you mentioned, Friday morning, 8:30 a.m., we will get the non-farm payrolls numbers as well as all the details from the August jobs report. And you're right, if you take a step back and think about where we were December 2023 heading into this year, markets hitting new highs, and we were thinking we're going to get rate cuts as we headed into 2024. But here we are, September 2024, we have yet to see a single rate cut, but expectations do remain high, JD.
I thought the Hawks were very loud on this. They said, oh, we're in for 3 to 6 rate cuts. I think that's kind of unrealistic given where core PCE, that really important inflation gauge, ultimately was for the Fed. Still more progress to be done, but any interest rate cuts for investors, even if they're later than expected, I'm sure will very much be welcomed news by all investors. Start to bring down those borrowing costs in the economy in a very cautious way. You don't want to go too fast, but we'll get a lot more information on that in the next few days.
Well, JD, I look forward to having you back on bright and early tomorrow morning, so thank you so much for joining me.
Can't wait. Thank you, Remy.
And we will be back right after the commercial break, so don't go away. Welcome to Global Money Talk, live from the New York Stock Exchange. Today we'll be exploring an asset that has fascinated humanity for thousands of years, and that is gold. The precious metal has had a historic rally this year, up 29% from Labor Day of last year. Well, today we're going to take a deep dive into the gold market with Tai Wong, independent proprietary trader. Tai, so great to have you here. Good morning.
Good morning. It's a beautiful day. Great to be here. So I've been in the markets for over 30 years, started trading foreign exchange, and then in the past 20 years or so I've been trading base and precious metals. Precious metals is really primarily gold, but also silver, platinum, and palladium. Base metals, copper, aluminum, nickel, all the things that we need to build stuff that's not iron. Iron's a separate market, but I've seen a lot of different crises, a lot of different markets. Gold has been something that's always captured my attention, and the world is always interested. So it's a great market.
And Tai, you've been through so many different market cycles, and so tell us a little bit about the current investment landscape from a macro perspective as well as a technical perspective.
So a lot to dive into today. A lot of reasons why people want to invest in gold. They want, a lot of people do it in jewelry. It's a tremendous store of value in India, more than perhaps any other country. The Chinese love it as well, but not so much as not so much as India. But then there's also ETFs where people can trade it as an investment. There are plenty of people who want physical gold. I worked in the physical business for a time, and every year they mint, for whatever year of the rooster or year of the snake, they mint special gold bars, and they sell out very, very quickly. So everybody's interested, not everybody, but a lot of people are interested in gold, but for a lot of different reasons. And on a technical basis, people really look at the charts, and we'll look at charts a little bit later on today.
And we've seen gold future prices near record highs. So what do you think is contributing to some of these gains?
So a number of reasons. One is in the last 2 or 3 years, we've seen inflation the likes that we haven't seen since really the 1970s and the 1980s. And there's people who believe that gold is a great inflation hedge. And I'll have a graphic a little later on that will talk about that and show it, is it really a good inflation hedge? Because there's a real story behind it. And then sorry, the second part of your question, I forgot.
So the current investment landscape, what are the factors?
Right. So, interest rates have been, due to inflation, the Fed has raised rates dramatically to levels that we haven't seen since the 90s, perhaps. But remarkably, gold has rallied in that space. So gold rallying in face of high interest rates is extremely unusual, and certainly first time I've really seen it in quite some time. And part of that is back to that inflation fear. People, there are a group of investors who really fear inflation, and they say, you know what, we need high rates because inflation's never now really going to go away. Another reason is sort of geopolitical. The war in Ukraine, and then the tensions in the Middle East. But let's start with the war in Ukraine first. The United States used sanctions against Russia, who's the aggressor, in the conflict, and I think that put alarm bells in certain countries who are saying, if we keep so much of our reserve assets, the assets that we hold, in United States Treasuries, we are potentially susceptible to some of that. Now, whether that is legitimate or not, or a legitimate concern, they want to diversify a little bit away from U.S. dollar assets. They're not going to be able to do that very much, but they've been putting a lot of their assets in gold, particularly central banks, particularly in emerging market countries. So that's one reason why gold is here. The other reason is it's like almost like a giffen good, where the more you have to pay for it, the more valuable it is. It's almost not quite a luxury item, but the idea is, gold has rallied tremendously, and that's why people are so interested.
And when it comes to investing in gold, many people have a vision of those bullion, right?
Yes.
And here at the New York Stock Exchange, we had a few cases where gold was carted onto the floor, and there was a lot of high security surrounding this. So In terms of ounces of gold, what does an ounce of gold look like for viewers out there who may not be familiar?
Well, gold is very dense, so unfortunately, you're not wearing anything. But an ounce of gold is quite small, but you'll feel it. It's very dense. It usually comes in a little plastic package. If I had one, I would have brought it today. But you can get it in different 5-ounce bars, 10-ounce bars, the 100, the 400-ounce bars, which are the big bars that you see in London, that you see in in central banks. There's 100-ounce bars that settle for settle futures. So you can see it in every way, shape, or form. And one reason is gold you can put into almost any form. You can mix it with metal. The gold never chemically doesn't change, which is actually maybe a good time for us to go to a graphic that I prepared. We get graphic number 1, and why is gold? And by the way, I would mention that this is the best periodic table website I've ever seen. It's called P-Table for all those chemical engineers who are gold traders who want to who are watching. What you find is gold as a store. I once asked myself, why gold? Why not some other metal? Why not something else? It really makes a lot of good sense. But in order for something to be a store of value over time and to be a currency, you need 4 things. It can't be a gas or a liquid because you can't carry that around safely or securely. It can't corrode or react, so you don't want it to change from an element into a different element because then you lose the value. It also cannot be radioactive, so because that would hurt you over time. And then finally, it's a question of it has to be rare, but not too rare. And once we get into that, all those 4 things, you're looking in the center of that periodic table. There's only a number of metals who can fulfill all of them. It's rhodium, it's palladium, it's silver, it's iridium, it's platinum, and it's gold. Silver tarnishes, and silver is big and bulky and heavy. It was for a time in the Middle Ages, certainly important, but not today. Platinum, palladium has a very high melting point, 3,000 degrees or thereabouts, and you can't really make that into shapes before the modern era. So all you have, and iridium and rhodium are too rare. So at the end of the day, the only thing you have, the only thing that works amazingly is gold. Now, I wish I could say that I was the, I found this analysis myself. So, there's an engineer who wrote about it, but it always remained in my memory. But I think it's worthwhile for the audience to see that gold is the only element that can do this.
Yeah, I think, Tai, it's really great that you brought this up and provide this graphic for our viewers out there, because it really sets the stage for a discussion today on gold. So when it comes to the investment thesis for gold, Tai, you've laid it out for us, but can you give us an indication of how much gold is actually mined every year?
Sure. Gold, partly because of the gold price, gold that's gotten out of the ground every year has generally increased. We're talking about approximately 110 to 120 million ounces of gold are brought out of the ground every year. And it's actually really remarkable how much ore and how much you have to dig to refine to get an ounce of gold. So on average, if you had an average sort of mine, you'd have to move a ton of ore to get maybe 5 grams of gold. So, about 32 grams in a troy ounce. You probably need 6 tons of gold for that little bar that you can buy. So it is really it's a lot of work, and it happens all over the world. What's interesting is gold. A lot of gold is mined in China, is mined in the United States, in Mexico. It's spread throughout the world because it's valuable, and with the price where it is today, people are trying to get as much gold out of the ground as possible. The other thing, since we're talking about supply, is gold, as we mentioned, it never tarnishes, nothing ever happens to it. Even if you mix it with other metals, you can refine it back out. So at current prices, we're getting something like 30 to 40 million ounces of supply coming back every year. So we're digging a fair amount of it. So there's a lot of supply coming out every year. And finally, just for our audience to sort of visualize, all the gold that has ever been mined. It's about 200,000 tons. Now that's not meaningful, but think of a cube about 65 feet on each side. Very, very incredibly heavy, obviously, but that's all the gold that we've ever mined in the history of it.
And you and I, Tai, before the show, we were talking about how expensive it is, right, to actually mine for gold, and all of the politics that come with the mining process. So I think that's something to keep in mind as we keep an eye on prices for gold. So while we're at it, we're seeing gold prices today hovering near the flat line, but can you tell us a little bit about how gold prices have been behaving recently?
Sure. If we get graphic number 2, I prepared a chart, and I find a chart is a little bit easier for people to see, and then at a glance you can see what's going on. So this is a 1-year candle chart. I love candles, and at some point I think we'll go into candles a little bit more, but that shows you that every candle there is it's a day's trading in gold. And we have moved from approximately a little below 1,000 to as high as 2,500. That's a pretty big move. That's a 20. I mean, it's a 28, 29% move actually when we calculated in the past year. Most of that, as you can see the arrow in the middle, came in the middle of the year when the market really felt that the Fed is now going to cut interest rates. So as markets often do or always do, they try to move ahead of expectations. Well, if it's going to happen in a few months, and people thought that would happen before September, actually, they started buying gold, and it's been on. We've had high after high after high. So gold looks pretty good. Interestingly, it's down today, even though interest rates are up. But I think it's because they're pretty much selling equities, they're selling oil, they're selling sort of all sorts of assets today. If we could just take a step back and look at gold in 5 years, so graphic number 3. So this, again, what I love about charts is, in a nutshell, it shows you what's happened over a certain period of time. So this is a 5-year chart. It goes all the way back to just before the pandemic. And you can see that it fell and then rallied after the pandemic as interest rates stayed near zero for quite some time. And then it was really, really sideways until about the middle of the chart. You can see that yellow circle. That's where China, the People's Bank of China, really started buying a lot of gold to add to their reserves. And I was trading the market at the time, and we realized that every time the price of gold got down to about 1750 or so, it would not go any lower, and it should have gone substantially lower. But after 3 or so tries, the market who was short gold primarily thought, something's going on here. Let's take a step back. And the People's Bank of China continued to buy fairly significant amounts for over 18 months, and only stopping about middle of the year. In that time, other reserve banks have been buying, and we have a graphic a little bit later that shows that. When there's that much buying in the market, the shorts eventually capitulated. They said, we can't get any selling momentum, so it's time to cover. And some actually added to become long holders of gold, and others went to perhaps find a different asset class to invest in. And finally, let's look at graphic number 4, which is gold in the very, very long term. And this goes back, I think this chart goes back sort of 6 decades. The first 2/3 of that chart was really when gold was essentially fixed to currencies. Then it traded in the $200 to $300 range for a very, very long time. It reached in 1980, famously, during the first inflation scare, to 800. And we didn't see that again. Now, 1980, we didn't see that again for, I think, 28 years, till 2008. So just remember that in that 30 years, a lot of assets have done a lot of different things, have gone up a lot, but gold really never saw a new high until then. Now, subsequent to the financial crisis, rates were lower than they had been in a long, long time, and part of that reason is why gold has rallied so much.
And Tai, I think it's very helpful to see these charts to get the 1-year breakdown, 5-year, and also take an even bigger zoom out and look at the 50-year. Right. But as you mentioned, there are so many different factors affecting price action. So here in the present in 2024, who's buying gold right now?
So really, there are quite a few buyers in terms of jewelry and fabrication and industrial, but the ones that matter to the market at the margin, that drive the market, I really think has been investors, but specifically central banks. And if we could look at graphic number 5, and show some details on some of the central bank buying. So you can see total supply of gold in a quarter is almost 1,300 tons, and near the end, at the bottom, above gold demand, you see that central banks this past quarter was a little slow at 183 tons, but the quarter before they bought 300 tons of gold. Now, in terms of total supply, you don't think that's that much, but on a marginal basis, if you're constantly buying, people are watching that. When the World Gold Council comes out with its periodic updates on who's buying gold, what central banks, people are watching that very, very carefully. And then briefly, if we could just look at graphic number 6. So I find that this is interesting, and I want to go. We have a lot to cover, so I'll go briefly. About 80% of central banks think central bank holdings will go up over the next 12 months. But only 30% of those expect their own reserves to go up as a central bank. So everybody thinks that central banks are buying, but not that many are buying, but the important ones are so far. Whether they continue buying, the Chinese have stopped over the past few months, from the data that we have available, remains to be seen.
Yeah, I think that's also very helpful as well. And to also get an understanding of which countries have been buying versus which countries have the most holdings of gold. But as you mentioned, Tai, we are limited for time, so I do want to move on to the price outlook for gold. So there are a lot of factors in play, but give us your outlook right now.
Sure. We could bring back up the gold graphic number 7, the gold long-term chart. So gold has had a tremendous rally. It rallied. We saw earlier that it rallied almost 30% this year, and generally speaking, you would say that maybe this reverses a bit, but it's been really tough not to be long gold. If you're a gold investor and you weren't, max long, you really said, "What have I missed? This has been a tremendous year." It's one of those charts where every time we have a sell-off in gold, it's come right back. So those things are hard to sell. So I think you keep a core long position in gold. If you want to take 20% of your position and say, I will sell a little here, I hope to buy it back $200 lower, you can certainly do that. But I think you need to keep a core long position in gold until we get a sense that this run is over. And the first signal we'll get is the price will start trading sideways. We will stop making new highs. We may make new lows, but we won't be making new highs. For me, what's most important is the market bought gold aggressively this year because they thought the Fed was going to cut rates. Now the Fed is going to cut rates. How will gold react now? If gold doesn't rally, then the market may say, you know what, maybe we got ahead of ourselves, and if gold doesn't rally, it may create a situation where a lot of longs saying, you know what, it's time to sell. Now, I don't think the central banks will be selling, but if we get low enough, they may continue to buy some more. So short-term outlook, I think we may get a modest correction, but I think you're safe remaining long this asset for the time being.
And Tai, sometimes when we read about gold, we might hear about the correlation to the U.S. currency. So can you give us a little bit of a breakdown when it comes to the correlation?
So on a day-to-day basis, and for me, I traded gold day-to-day. I was a market maker, had a lot of clients who were mining companies as well as consumers. the thing that's most important on a daily basis is what is the dollar doing today? And we look at the dollar index because it's a combination of euro, yen, the Mexican peso, the Canadian dollar. What is it doing today? So that on a daily basis is probably the most important thing. And then following that would be where short-term interest rates are going. But short-term interest rates drive the dollar. So it's really a dollar and gold sort of on a day-to-day basis. But you bring up a very good question, because in the past 3 months when we've had a tremendous run-up in gold, that link to the dollar is less strong than it has been. So sometimes when nothing's going on, literally gold and dollar will trade tick for tick. Dollar ticks up, gold ticks down, and vice versa. But when gold has had this rally, it has sometimes ignored the dollar. The dollar might be up, but they're still buying gold.
And I think that's a very key distinction right there, especially what we've been seeing in that correlation the past several weeks and months. And this is something that you mentioned at the top of the show, Tai, and you mentioned gold. And is it a good inflation hedge? So can you break this down for us, and what is your take on this?
So, that might be the question of the hour, because the sort of consensus the conventional wisdom is you buy gold to hedge against inflation. So I found a great graphic. Can we go to graphic number 8? And this is from Fisher Investments, and it's probably the best chart I've seen. So you can see that the green line that's sort of flat is CPI, which is inflation, and this is the U.S. The yellow line naturally is gold, and then the bluish line is the S&P 500. And this is a chart that goes from 1975, and it's made to equalize sort of the percentage gains in each asset. So if you look at the yellow line versus the green line, you'll see that for many, many years, until really 2010, gold has underperformed inflation. So it hasn't been really, during that period, a good hedge. So imagine if you bought gold in 1990 and you said, okay, in 2005, I'm going to sell it. It was a hedge against inflation. You've done very, very poorly. And as a matter of fact, you could argue that if you really wanted an inflation hedge, you're better off with the stock market, because the stock market has outpaced both gold and inflation substantially. Now, taking a step back, I think if your view is very, very long, 20, 30, 50 years, if you're going to hold these assets for your children, or you're going to say, I'm only putting 5% of my money in gold because it helps diversify the rest of my portfolio, then it's a good investment. But as an inflation hedge, it really depends on when you get in and when you get out. So you have to take it with a big shaker of salt. I wouldn't even say a grain of salt.
Not even a grain.
Not even a grain. Much more than that.
Naturally, Tai, my next question to you is, what does really drive the price of gold and what doesn't?
It goes back to, I think really it's the interest rates and the dollar most of the time. Okay. You do get big spikes when there are unforeseen issues in the world, geopolitical issues. Gold was actually on a significant downdraft, and then October 7th, 2022 happened, and that downdraft reversed incredibly dramatically. So it does still move on geopolitical concerns. What it does do, though, is it moves, if it moves a big amount at the headline, and then it increasingly moves less as the market gets used to the headlines. So that's definitely true. The first move is tremendous, and then it gets slower and slower. So, and I think inflation also, concerns about inflation, even though inflation is coming down quite dramatically, there are folks who believe that this is just a lull, and with the different things going on in the world in terms of green and sustainability, which tends to be expensive, that we will see more inflation. So the fear of inflation, despite the chart that we just saw, still drives a lot of people. And then a lot of people just like it at the end of the day. India, whenever there's a dip in the price of gold, will buy. But if there's a big rally, they will actually come up and sell. There's some of the Indian retail investor are some of the savviest gold traders out there.
And speaking of trading, we have about 5 minutes left to today's show. So for people out there who are curious, how should a retail investor invest in gold? What's your take?
So let's bring up graphic number 9. And really the best way for the retail investor in the United States, and I think in most developed markets, to invest in gold is using physically backed ETFs, so exchange traded funds that are physically backed by gold in a vault.
Okay.
So for example, the SPDR gold share, the GLD, every ounce that's traded in that ETF, sits, I think, in an HSBC bank vault somewhere. They don't lend it out, and it's totally safe. And what's great about this is it trades like a stock. The spreads are narrow. There's a price all the time. Very, very liquid. You can get out anytime you want. So if you're betting on market moves, or you're a short-term or medium-term investor, you don't want to have to cross a lot of spreads. The ETF is really the way to go. There are a lot of ETFs, but I put a red box around the ones that I think you should stick to, and those are the ones that have a lot of assets. That means they're very, very liquid. The prices you're going to be able to buy and sell probably within 30 or 40 cents, if not less. One quick question here is the year-to-date returns are slightly different, and that's based on how much the ETF charges per year. So GLD has a lower return than some of the other ones because they charge 40 basis points. Some of the other ones charge as little as 15 basis points. So yes, it will erode your return in gold a little bit, but for the convenience and the fact that it appears on your stock portfolio for tax reporting and all those different things, ETFs are really the way to go for sort of investors and speculators who in and out, who don't need the physical gold.
So you would recommend the physically backed funds versus the actual physical gold itself?
So yes, because with physical gold, the spread that you pay, and I think you probably pay maybe 50 cents on an ETF, the spread on a physical bar of gold could be 1 or 2% easily.
That's significant.
That is significant. And let me show graphic number 11, and it should, but for the investors who want physical gold, the best place that I bought it is, sorry, that's graphic number 11. I'll come back to 10 in a second. Is Costco.
Yes.
I was
we
in
heard about this, right?
Pittsburgh Costco, and they were selling wafers of gold, and I looked at the price, and this is over the weekend, $25.50 for a PAMP piece of 1 ounce bar of gold. PAMP is, for some reason, the one that the investors like the most. MKS PAMP from Switzerland. They love it. It comes, in this case, in a Statue of Liberty, and it was only for a physical bar of gold. It was only probably 1.5% over where gold was trading last, which is really amazing. So I think you can only buy 5 bars, but if you wanted a bar of gold, a few bars of gold just to keep, Costco is the best place to buy it. One thing I would warn is, do not take it out of the packaging. If you take it out of the packaging, then when you want to sell it, or whenever your kids want to sell it, they're going to have to get someone to assay it, and someone will charge you for that. So leave it in there, look at it, but please don't take it out of the packaging.
Okay, well, Tai, this is very interesting, and I know there's a lot of focus on gold being sold at Costco here in the U.S., and there are shoppers who wanted to know which locations actually sold this, but hopefully we can address this as we kick off this brand new show live from the New York Stock Exchange. Tai, this is so exciting for you.
Yes. Oh, one more question I actually would get to. If we could bring up graphic number 10 again, and you had asked this earlier, what about, mining? It's, gold mining companies. And people have asked me, that should I buy mining companies or gold? And if you look at this graphic very, very quickly, gold mining is a really hard business. You have to. They're sometimes in countries that are that have tough unions, that have workers who are perhaps not the best trained, but you can see from the chart you're much off better buying the commodity than the miners themselves.
Okay, Tai, well, we are all out of time, so thank you so much for the deep dive into the gold sector and lots of good info for our viewers. And that will do it for our first episode of Global Money Talk live from the New York Stock Exchange. We are so excited to bring you daily coverage here on SamPro TV, and you can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll see you back here bright and early tomorrow. Have a great day.